China didn't ring a bell. They didn't hold a press conference. They just quietly did something the silver market was never designed for. They stopped refilling the shelves. In the last video, we walked through a stunning number. China's visible stockpiles down 86% from their peak. That wasn't a meme chart. That was industrial metal. Bars that feed factories, electronics, solar, and defense, vanishing from official warehouses. Now the story just got bigger because today's data isn't just about China. It's about London and Shanghai, the two main superhighways of global silver, starting to flash the same warning at the exact same time. Inventories tight, delivery harder. Spreads weird. So here's the question. If China's vaults are emptying and London and Shanghai are both feeling the squeeze, where exactly is the world supposed to get its silver from next? By the end of this video, you'll understand why China's vaults empty is not just a China problem, how London and Shanghai quietly act as the lungs of the entire silver system, and what a normal person can do before this turns from tightness into outright shortage. 1. What does China's vaults empty actually mean? Let's slow down and decode that phrase, because it sounds dramatic, but it's not magic. When we say China's stockpiles dropped 86%, we're really talking about 3 layers of metal. Visible exchange inventories. The silver sitting in Shanghai Futures Exchange warehouses and other tracked sites. Industrial working stock. Metal held by refiners, fabricators, and manufacturers, ready to be turned into products. Strategic and shadow reserves. Metal that never shows up on public dashboards, held by state-linked entities or large players. In the last video, we focused on that first layer, the visible pile, the one everyone can see, the one traders quote in articles, the one charted in red and green bars. When that pile drops 86%, it means something simple but brutal. China is drawing more metal out of the global system than it is putting back in. It's like watching a giant supermarket with one entrance and one exit. If the shelves keep getting lighter, while the delivery trucks don't get bigger, you don't need a PhD to know what comes next. And here's the twist. China isn't just any customer. China is one of the biggest manufacturers of solar panels, a major electronics producer, and a country that thinks in decades, not quarters. When they let their visible stockpiles collapse, it usually means 2 things at once. They're willing to pay up to get metal, and they're not in the mood to supply the rest of the world at cheap prices. That's not a local story. That's a global choke point. 2, the East-West Bridge is creaking. Now connect that to London and Shanghai. London has been the world's silver parking lot for decades. Big bars, big trades, big banks. Shanghai is the main financial bridge for silver into and out of China. Price signals in the East meet metal flows from everywhere else. Most of the time, these 2 centers behave like a healthy pair of lungs. Metal moves in and out. Price differences open slightly, then close as arbitrage traders do their job. Spreads stay boring and tight. But when inventories get tight, that picture changes. Suddenly you see persistent price gaps between London and Shanghai. Premiums in one region that don't fully close, delays and partial fills on large orders, and traders whispering phrases like hard to source size, which is code for the system isn't breathing properly. This is how a global shortage starts, not with a single dramatic event, but with dozens of little frictions. A refinery that can't get feedstock on its usual terms, a mint that quietly extends lead times, a bank that steps back from offering large physical quotes, a factory that asks, can we substitute? Can we use less? None of this shows up in the spot price on your phone. It shows up in the plumbing. And the plumbing is telling you, tight everywhere 3. The 3-stage domino setup. Now I want you to see the structure behind the headlines, because this isn't random. You can think of what's happening as 3 dominoes. Domino 1. The East hoards. China allows visible stockpiles to drain. Imports stay strong. Exports of refined silver stay controlled. In plain English, we're keeping more. We're sharing less. This alone tightens the global pool. Domino 2. The West thins out. London's role has always been to always have some, A warehouse system that can deliver big bars to big players on demand. When China soaks up more metal, that always have some pile starts to shrink. Maybe not to zero, but to levels where large orders move the market more than they used to. Backwardation, spot above futures, pokes its head up, premiums stick instead of fading. Now the West feels what the East already knew. This isn't as deep a pool as we thought. Domino 3. The system says no more discounts. This is the crucial step most people miss. There's a moment where the market quietly flips from we'll sell to whoever pays a bit more to we'd rather not sell at all at this price. That's when mines hesitate to hedge future output at low prices, recyclers hold inventory instead of dumping it. Governments and big players stop being net sellers and become net buyers. The result? The float, the metal actually available to trade, collapses. Not because it vanished from Earth, but because the people who control it no longer think current prices are fair. That's a shortage. Not we're out forever, but we're out at this price. And every time that's happened in history, the next phase has been the same. The price doesn't politely ask for a raise. It jumps until someone finally says, okay, at this price, I'll let some go. 4. Why China's empty vaults changed the game. So why is China the part of this story you cannot afford to ignore? Because of how they think. Western traders think in quarters, bonus cycles, election years. China thinks in 5-year plans, industrial policy, generational advantage. If China is willing to let visible inventories drain to the bone, they're not doing that for a quick scalp on the chart. They're doing it to secure inputs for solar buildouts, EVs and battery systems, high-tech manufacturing, military and space programs. And here's the uncomfortable part. From their point of view, every ounce of silver they quietly tuck into long-term industrial or state use is an ounce that will not be available when the rest of the world finally wakes up. So you have thinking in how much metal do we have for the next decade? West. Still thinking in what's the price this week? Guess who wins that game? 5. What the price isn't telling you. Let's talk about the chart for a second, because this is where most people get lulled to sleep. Silver has this reputation. Sleeps for years, wakes up violently, puts a few people on magazine covers, then goes back to being that metal no one cares about. So when you say global inventories are tight, China's vaults are emptying, London and Shanghai are squeezed, the average person glances at the price, sees it hasn't gone vertical yet, and shrugs. If it was that bad, price would be higher. But that's backwards. In every past squeeze, the inventory stress showed up before the explosive move. Gold window pressure before the 1,970 seconds run. Hunt Brothers delivery demands before $50 silver. Palladium shipment delays before its face melting spike. The price is the lagging indicator. The plumbing is the early warning. Today, the plumbing is telling you China is hoarding. London isn't as deep as it pretends. Shanghai is paying up to secure supply. The float is shrinking. You don't need to know the exact day silver moves. You just need to ask, do I want to be the one trying to buy in a world where everyone suddenly discovers the shelves are bare? 6. How a normal person responds without panic. Let's get practical. No hype. No all in. No leverage roulette. 1. Shift from price guessing to regime thinking. Stop asking, will silver be at X by next month? Start asking, what does my life look like if the era of cheap silver ends? Because if China, London, and Shanghai are all flashing tight, we might be moving from a cheap silver regime to a structurally scarce silver regime. In that world, the real mistake isn't buying too early. It's never owning any. 2, decide your role. Gambler, tourist, or owner. Be honest with yourself. If you're here to trade every wiggle, that's gambling. Admit it and size your risk accordingly. If you're just curious and want a token amount, that's tourism. Fine. Just don't expect life-changing results. If you see this as a long-term shift, your job is simple. Build a position you can sit on. without losing sleep. That means no leverage, no positions you're forced to sell in a dip, no dependence on I'll get out in time. 3, pick a sensible allocation, not a fantasy. Instead of dreaming about doubling your money overnight, ask, what percentage of my net worth, if held in real silver for the next 10, 20 years, would make a meaningful difference if this regime change is real? Maybe that's 5%, maybe 10, 15%. For some, split between gold and silver. Write it down. Stick to it. That number is your anchor. When headlines scream, you don't chase. You just keep building toward your allocation. 4, own what you can actually touch. Eventually, remember the core lesson, paper exposure. Great for trading, terrible for surviving a structural shortage. Physical ownership, boring to talk about, powerful when the system cracks. I'm not saying never touch ETFs or futures. I'm saying don't confuse them with protection. If China is hoarding metal and global inventories are tight, the real hedge is simple. Coins and bars from sources you trust, stored in ways you understand, under your ultimate control. 7, the East is playing for keeps. Are you? We're watching a quiet race. On one side, nations thinking in decades, governments securing strategic materials, industrial giants making sure their factories never run dry. On the other side, traders arguing over a few cents on the spot price, commentators treating each move like a meme, ordinary people assuming there will always be more. China's visible vaults are draining. London and Shanghai are tight. Global inventories are hitting critical levels. At the exact moment, the world is demanding more silver, not less. There will come a day, maybe months from now, maybe years, when the story flips from silver seems tight to we can't get what we need at any sane price. On that day, the question you'll ask yourself will not be, did I buy at the perfect tick? It will be, did I own anything real? Before everyone else started clawing at the same dwindling pile.